Global slowdown concerns are mounting in the middle of the U.S.-China trade war. China's industrial output growth slowed to 4.4% in August compared to the same period a year earlier. That is the weakest rate for the country in more than 17 years. Samantha Azzarello is the JPMorgan Global Market Strategist, and she's with me here at the desk. So we've been watching a lot of China data. Obviously, we've seen the numbers start to slow down, although we're still seeing growth there. Found it was interesting. Last week, we had Leila Miller on talking about the China numbers, saying, look, China now feels comfortable seeing the numbers start to decline because they see the tide turning, and they can point to the U.S. to say that is the reason why our economy is starting to slow down. What do you make of that argument?
I mean, it's a really interesting point, and I definitely think there's validity to it. And if you saw, one of the premiers spoke today, and he basically said, we might not see 6.5% growth. And you think back to the day that China would never let those growth numbers dip below the level that the market was really expected to. But the truth is, this trade war is prolonged, and there's no denying that it is hurting Chinese growth. And they do have something to point to.
Yeah, I mean, where do you think those negotiations stand right now? Right now, we're looking at a potential discussion starting in October. It seems like both sides are starting to at least have communication, say we're willing to come to the table on certain things. What's your overall outlook on that?
I will say we saw a bit of progress, right, with obviously China rolling back some tariffs and then the U.S. following suit. That being said, it could deteriorate at any moment. It could also get better at any moment. And we just don't know how to model that, right? That uncertainty, that volatility, because the truth is there has not been a playbook and we just don't know. And I know that's really kind of not the greatest response to that, but the truth is the way we're expressing that in portfolios is we're taking risk off the table. We just are, because this trade war, it's not modeled, we don't know how to model it. We don't know how to quantify it. And the fact is it's going to keep impacting markets and we don't know when it ends.
So you're taking some risk off the table. When you look at all the hotspots globally, what does that mean in terms of your strategy for your portfolio? Does it all just come back to the U.S. because the U.S. is the one strong story that's going still?
It's true that the U.S. is still the only bright point, I would say, in the global economy, in particular the U.S. consumer. That being said, we think about U.S. growth, and I know you spoke about that, rotation earlier to value. That's something we've been saying for the past probably 8 months, right? This idea of overweighting value versus growth, overweighting income. Any company that pays a dividend, at least a smart dividend, we're willing to take that over a growth name right now. And part of the reason is we were expecting a reversal, but part of it is we just need to buffer the portfolio effectively from swings.
We've got the Fed meeting starting tomorrow. What is your expectation on that front? It seems like, a few months ago, the expectation was that an additional cut, at least 25 basis points, was a sure bet. Now, not so sure.
It's not so sure, actually. I would completely agree with that. So we think they're going to cut rates tomorrow. I know the market's pricing in one other cut through the rest of the year. That's up in the air. Because frankly, the Fed is trying to show that they're flexible and nimble. And I think they got locked in step with this idea that they were only going to be raising rates. Similarly, they don't want to be locked into having to lower rates now. So they want that, they want the flexibility to be nimble, to say, given what happens with conditions, we are going to raise, we're going to cut, just depending on what we see. We don't think this is going to help the economy. We think it's just a psychological boost to markets with, if anything, it's only going to be short-lived. And all you had to do was look at the response to the ECB easing stimulus to know that markets are a little bit over this.
And in the ECB move that we saw, the additional cut, but also the restart of the asset buying program, we had a guest on last week who said, look, this is a watershed moment because it just shows that these central banks simply can't get out of QE. I mean, how did you see the decision last week?
We were a little bit disappointed. I think we expect a lot from monetary policy, and we've all come to the conclusion fiscal policy, government policies need to be pulling their weight across the globe. With respect to QE, do we ever get out of it? It's very bizarre. There's $16 trillion in negative yielding debt globally. We were talking about this with a colleague earlier this morning. You think about a textbook. We don't even have that in a textbook. We don't even know how to deal with that, how those prices behave. This is just unprecedented, and it almost feels like the central banks are making it worse, the ECB, with this kind of policy, when the fact is, Europe isn't in a recession. So do they need this? In our view, no, they don't.
Okay, Samantha, always good to have you on. Samantha Azzarello joining me here at the desk.